Mrs. Kyle here. Today we're going to start Chapter 9, 9.1 Work Together, that deals with notes payable. Basically, a notes payable is a promissory note signed by a business and given to a creditor that you're going to borrow money from them and you're going to pay them back in a certain amount of time at a certain interest rate. So the principal of the note is the original amount of the loan. So say you want to borrow $5,000. That's the principal. The maturity of the date is when it's due. So whether it'll be due in 6 months, so 6 months from the date you take it out will be the maturity of the date. And the interest rate is calculated on an annual rate of how much you're going to pay back. All right. If you're borrowing money for longer than 5 or more years, that's going to be a bond, and we'll talk about that later. Couple things you need to do. Let's see. Calculating interest, we talked about. It's usually an annual rate. We'll have to figure it out for the time. When we figure out our interest rates, banks use 360 days as opposed to 365. So if you're wondering why we're using 360, because that's typically what a bank will use. And they determine the rates by the prime rate. So depending on your credit score and your credit history, you're going to get the prime rate plus 1% or plus 1.5%, whatever it may be. A bank may require you to pay your interest on a monthly basis instead of all at the end when it matures too, just so you're aware. All right, so if you want to turn to page 265. 265, and we're opening up 9.1 Work Together. So it says a cash receipts journal and a cash payments journal are provided. Source documents are abbreviated as C for check, R for receipt. Number 1, using the current year, journalize the following transactions in the cash receipts journal. So we're receiving money. So our first one, our date is May 14th. May 14th. And what we're getting here is notes payable. Our document number is receipt 145. All right, so we are receiving the cash. We borrowed $5,000, so our cash debit is going to be $5,000, and our general credit, $5,000. So we have to pay back $5,000 in 90 days with a 12% interest rate to First National Bank. All right, then again we borrowed on June 5th. Oh my goodness, June 5th. Notes payable, receipt 213, and this time we borrowed $8,000 from American Bank. We have 180 days to pay it at a 10% interest rate. So it's going to be $8,000, general credit, cash debit of $8,000. All right, so now the next thing we have to do is figure out our maturity dates. So our first one, it's going to be 90 days. So our total, we're going to work backwards here, it's going to be 90 days. So May 14th through May 31st. So we're going to subtract to figure out how many days that will be, which is going to be 17 days. June has 30 days in it. July has 31. And August 1st to the 12th is going to give us 12 days. So when you add these up, it's going to give you 90 days. So our maturity date will be August 12th. All right, June 5th to the 30th is going to give us 25 days. July's got 31 days. August has 31 days. September has 30. October has 31. November has 30. And 2 days till it matures in December for a total of 180 days. So that's how we figure our maturity dates. You just have to know how many days are in a month. All right, so now our interest rate. So our May 14th, we borrowed $5,000. So it's going to be $5,000. Our interest rate was 12%. Now, time is a fraction, so we got 90 days divided by 360, because again, that's what the banks use. So when we would go ahead and do this calculation, the interest due at maturity is going to be $150. Okay, so $8,000 we borrowed on June 5th at the rate of 10% for 180 days. When we go through and we do all the calculations, we're going to end up paying $400 in interest. All right. Next thing they want us to do is journalize the cash payments, so we're going to actually pay now on the maturity. So paid cash on the maturity value of $5,000, check 345. Check 345. So our first one is due on August 12th. So it's going to be notes payable and then interest expense. Okay, so the $5,000 from our principal, our $150 for our interest. So we're going to give them a cash credit, $51.50. All right, so our second one matures on December 2nd. Notes payable. Check number was $652. Borrowed $8,000, and we have to pay $400 in interest. So interest expense. So for a total of $8,400. All right, that's it for notes payable. So it's basically like just taking a loan out for a short period of time. We're going to check our answer. Uh-oh, 2 points off. What did I do? Oh, July has 31 days, not 3. And I forgot my receipt number up here, R213. Alrighty. If you have any questions, contact me in Moodle or ask your classmates on the board, and we'll get back to you. We're going to do Chapter 9 on your own, 9-1 on your own, and we also are going to do the applications for this chapter. Thanks. Have a good one.